Okay, good evening, everyone. For those of you who missed it just now, I'm Billy Toh. I'm the Regional Head of Retail Research. So today is our first series of webinar with the Joyful Investors Level Up. Basically, this webinar will be a combination on how the market has been behaving and what the market outlook will be like, as well as some educational stuff that we'll be sharing. So we will start off with a quick presentation, about 5 to 15 minutes of presentation before we jump into a fireside chat series. Right. During that period of time, feel free to just put your questions into the Q&A box. All right. I think I will do a brief introduction on what the market is. I think a lot of people will probably want to know a bit on that, especially given how we start the year. Okay, but before we start, just a quick disclaimer. All right, so basically this is more on educational. All right, if you have anything that you wanted to make any investment decision, you are advised to make your own independent evaluation, as well as to talk to your financial advisors on especially whether if this fits into your overall investment objective. All right. Okay, so first thing first, I think the global market outlook as we stand, I think the first thing that we need to look at is how 2026 is going to look like. I had just actually finished an interview with Dinesh in Singapore recently. So I was talking about how bullish I am about the market before Donald Trump made his remarks on some of the Greenland issue. But I do think that this is a time where you have a lot of things like whether it's tariffs, whether it's geopolitics. And of course, I think the structural growth driven by AI will remain the same. But throughout this, I think it's not just at the start of the year. I think even at the end of last year, we have seen quite a bit of rotation into some of the different, into some of the different, especially the smaller caps as well, into different markets as well, and not just focusing on US markets. But what we felt at the start of the year is that markets are unstable, but it's not a breakdown. And I think the geopolitical uncertainty that we are seeing, especially at the start of the year, whether it's the Venezuela incident or whether it's the Greenland incident, it is part of the new normal, and market will adapt to it, as we have seen recently. And I think as long as the geopolitical tension that we are seeing do not cross a certain threshold, what I meant is that it doesn't result in a full-blown war, or result in a scenario where it affects, for example, your commodity prices, such as oil prices and all that. So I think as long as we do not spill over to that level, market will actually adapt to it. And because part of it is because some of the structural growth that we are seeing across, not just in US, I think in ASEAN, in Hong Kong, in Japan, I think even in China, some of the shift that we are seeing, all of that remains intact. Now, so why markets feel so volatile right now? I think this is a time horizon problem, right? So what's driving it is, of course, your tariffs and geopolitics. Whenever Trump tweet or post on Truth Social, it will actually move market. And of course, the crowded positioning that amplifying this move. I think we all know that the S&P 500 and of course the Nasdaq 100, a lot of the rally has been driven by a lot of AI driven names. And it's not just that. Even, for example, you look at South Korea, for example, you look at different markets, you see it's driven by more or less a similar sort of thematics that we're seeing. And that crowded positioning amplify the moves in the market whenever there's a news that sort of go against the narratives that we believe in, right? So the short-term movement that we are seeing is actually at a very volatile pace, and it's actually faster than what the fundamentals is telling us. So that's why we felt a lot of that. So you look at the numbers here, you can see what I meant by that, right? If you look at this, is basically as of 20th Jan, before the rebound that we saw in the US market recently. So you can see that the 1 week numbers, you can see from here, across the markets, most of it is in red. Right, you look at US as underperformed severely because of the threat on some of the, I think the sell American narratives that the news has been amplifying on. And but similarly, you look at the 1 month return and of course the year-to-date return, you can see that US has been struggling, but of course the rest of the market has been doing pretty mixed, right? Especially you can see South Korea is doing very strong, but India market remains very weak, right? So you see that, and of course for Europe it's a bit uneven, even within the same month itself, right? You can see it's doing good in the month itself, but just a week, just if you look at it on a 1 week basis, you can see market has actually tanked quite a fair bit because of what Trump threatened to do. But if you look at it on a longer term basis, right, don't look at the 1 week, 1 month, and year-to-date performance, and you look at compounding growth is remarkably consistent. This is where wealth is actually built, and we'll probably talk a bit on some of that as well as we move forward. So you look at the 3-year, 5-year, and 10-year return. So you can see that on a 10-year basis, the US actually is a leading market. But of course, if you look at the last 3 years, US probably underperformed some of the market, especially the Dow Jones and the S&P 500. But the Nasdaq 100 continues to outperform, right? So what I'm trying to tell you is that across the longer term basis, almost all markets actually perform, right? You can see that Asia market, Japan, Vietnam, Indonesia, all of them have powerful cyclical growth that we are seeing, right? Even the Bloomberg World Index, if you can see on a 10-year basis, actually done exceedingly well. Of course, I wanted to highlight some markets like your Vietnam market as well as Singapore. I think they've both done very well for some of the reasons that we will talk about during our conversation later as well. Now, I think in this environment, we really need to be a bit more savvy in terms of how we look into our portfolio rather than trying to go into full defensive or trying to just take advantage of the rally. I guess the idea is really to park your investment into three bucket portfolio, right? Going to defensive that allows you to invest without having that concern. I think this is basically to allow you to survive that volatility, right? So put about my own recommendation would be around 30%, but it really depends on the type of investors you are, and of course your age as well as where you are at the stage of life, right? So I think to do that, one of it, of course, gold. I think if you look at gold prices have continued to do well because of all the uncertainties that we are seeing. So there's a lot of hedging on that front. Of course, I do recommend, especially for those of you who are attending here who are from Malaysia and Singapore, do look at quality dividend play in your home market, because I think that's where you should really start your base, especially when it comes to investing. Of course, take advantage of some of the money market, especially those with attractive yield that offers you. And in terms of tactical, it's really just to ride on the cycle. And I think this where technical helps a lot. I think Hazel will share some of that as well. And if you've been following us, you could probably notice some of the trading ideas by Viren, Ching Po as well as Sesiang. I think those are allowing you to really take advantage of some of the trending thematics during the short period of time. Right, so some of those includes your sector rotation into other plays, into healthcare play, for example, industrial in US. Then, of course, your Asia ETFs and some of the select opportunities when there are pullbacks. For those who are looking at longer term basis to compound wealth, I think you need to look at some of the structural growth stories that we have. I think we've talked about the US AI stack at the start of the year. We actually wrote an idea on that part. Then, of course, some of the semiconductor and cloud opportunities, especially in Asia as well. South Korea offers a lot of that opportunities, especially because of their involvement in the AI memory chip. So those are really some of the areas that you can look into. US and Hong Kong have some of the opportunities as well on the front. So I think Hong Kong is also an attractive play that we are looking at. I think our analyst has a 15% upside for the Hong Kong Hang Seng Index at the start of the year. So there's still a lot of room to run, despite I think the Chinese government came out with quite a few regulations to more or less control or contain the sort of hype that we are looking at. I think at the end of the day, the understanding in Hong Kong is that we do expect to see a slow and gradual rally. Right, I am not going to touch too much on this strong structural longer term growth and strategies by markets. I think we can address that later on as we go along the way. All right. I think we will discuss this later in a fair bit. I'll just pass the time to Hazel so that Hazel can do a presentation. Yeah.
Thanks, Billy. All right, let me try to share screen first. Okay, are you guys able to see my screen clearly? Okay, just let me know in the chat box if you're able to see my screen clearly, right? Just type a yes if everything is good and the sound and everything is all right for you guys. Okay. Okay, thank you. So first of all, good evening to all of you, especially for those of you who actually joined in late. Right. So this is a webinar that is conducted by CGS together with the Joyful Investors. Right. And Billy has just shared his take on the market outlook and a good update on what's happening in the world right now. So for me, I'm going to dive deeper into the US markets portion on how we can actually invest in the US markets in 2026, right? But before I dive right into that, I think it's important for me to do a quick introduction of myself. Especially for those of you who do not have a chance to actually attend any of my webinars or workshops, seminars before in person. So firstly, my name is Hazel and I'm the co-founder and chief trainer of the Joyful Investors. So who is the Joyful Investors? We are actually a financial education firm where we empower retail investors how to invest more prudently, with more clarity, with a proper investing framework, rather than just chasing after returns blindly. But we want to take care more of the risk side, or what we call risk management, right? So instead of gambling or looking at what is the a market trend, chasing tips blindly. You need to have a proper framework so that can guide all your buying and selling, investing decisions in the markets. And personally, I do believe that the ultimate goal for us when we invest, for all of us, is you want to achieve financial freedom, right? Because when you achieve financial freedom, that is when you can design a life on your own terms, whereby you don't need to worry about money, right? Don't need to worry about high cost of living, inflation. And that's the reason why over the years I've been doing various topics on investing, whether is it on REITs. Some of you may know me through my past sharing of REITs, or whether it's technical analysis, stock investing in general, ETFs, and many other topics. Aside from my role at the Joyful Investors, I'm also a trainer with SGS Academy, with SIAS, and also with ISCA. So I have been working closely with these various bodies for their investor education program, right? Now, before I dive right into the US market, just a very quick usual disclaimer. Whatever I'm sharing tonight is for educational purposes. So please do your own due diligence and proper research before you dive into any investment or any trade, right? We might use some stock examples or certain markets, asset classes in the sharing, but these are not financial recommendation, right? So what I want to do is I would like to build on to what Billy has talked about. So he has given a very good overview of all the various markets. But if you dive deeper into the US market, we have just ended the year 2025. And if you look at the sector performance of the US market, I think one thing is really clear is that the market is pretty split, right? There are some sectors that are doing really well, right? As you can see, the top sectors are delivering over 20% returns or close to 20% returns last year in 2025, while we do have some sectors which are just breaking even, right, at the bottom of this list. They have struggled and they have put down the overall returns for the market. So let us begin with the laggards first. So if you can see from this table over here, you can see the top, or rather the last five, the bottom five underperforming sectors over the years. They are the consumer staples. XLP stands for consumer staples. XLRE is the real estate. We have energy sector. We have XLY, which is the consumer discretionary, and XLB, which is the materials sector. So when people see the list, or when investors see such a list, I think the first instinct that many people have is that they will think that, okay, so these five sectors, they are very weak. I should stay away from the markets heading into 2026. I should not invest in these sectors. But the thing is that markets are rarely that straightforward, because every year what you realize that there's something that is always common, which is that there are some parts of the market, certain sectors, yes, they will fall behind. But it's usually not the same sectors that are falling behind or the same sectors that are always doing well. So therefore, what it tells us is that underperformance in a particular year on its own, it does not automatically make something unattractive. And the reverse is true as well. When you have outperformance, it does not automatically make it safe to invest, or that you are definitely going to get the same kind of results as the year before. So all these numbers, what it really tells us is just which part of the market is providing the leadership and which part is not providing the leadership. In fact, I think it's really risky, or it's quite tempting for investors to assume that yesterday's winners will continue on to win, and yesterday's losers will continue on to lose. But there is this thing whereby the markets have a natural tendency to do some mean reversion at a certain point in time. And this usually happens when the valuations or when the prices in certain sectors are overstretched already, right? Where you have hot rallies, and when they start to cool down, then some of the previously unloved asset classes or even sectors, they might start looking more attractive and they might gain more attention. Now, at the other end of the spectrum, we also have the top three performing sectors, which is the IT, the information tech. We have communication services, and we also have the industrials, right? So even within the top performing sectors, what I believe is that returns are usually concentrated still within a small group of companies within these top three sectors. So what that means for investors is that it's important to stay selective if you are doing individual stock selection, right? The overall sector might do well, but it doesn't mean to say that all of the companies in that sector are doing well. Usually it's due to a concentration of a small group of companies that are really pulling up the returns because they're delivering very good earnings growth and they're executing their business really well, right? Now, over the long term, what we do see that, yes, over the long term, outperformance tends to fall back to sectors that can consistently drive earnings growth. So the difference over here for this chart in this slide versus the previous slide is that this chart shows us the performance over the last 10 years. The previous slide, I was only showing you for the year of 2025, last year. So if you look at the long-term performance, something that you might notice a trend is that the leadership often comes from the tech-related segments, right? So your XLK, the graph in gray, that is the technology sector. So it's not because technology is fashionable or simply because the world keeps talking about AI and that's why the technology sector tends to do well. It's usually because the companies that are within this space of technology, they have the potential to either improve productivity or to develop a more defensive kind of business model, or they can scale earnings in a very good way whereby other sectors cannot match. And that is why they have the foundation of good earnings growth, and that translates into a better price return performance in terms of the stock market returns. So if you can see, the common thing is it goes back to the earnings, right? So stock prices in the short term, yes, it can move for many reasons, but without earnings strength, usually such kind of a short-term rally will not be able to sustain. But if there is a good earnings strength and growth, then this is where you can see a better long-term outperformance for certain sectors or even certain companies, right? Now, so that is for sector rotation, which tends to play out year on year, all right? But aside from sector rotation, what we're also seeing is that we are beginning this new year, 2026, with the steepest US yield curve that we have seen ever since the last 5 years, right? Back in 2021. So if you look at this chart over here, how to make sense of this chart is that the red color curve, that is the yield spread between the 2-year US Treasury yield and the 30-year US Treasury yield. And you can see that this red color curve is increasing, which means to say that the yield spread has been widening significantly recently, right? So why is this happening? It's happening for a few reasons. Firstly, is because investors are expecting that the Fed funds rate is going to ease over time, that we're going to see rate cuts. So that pulls down the short-term yields, that lowers the short-term yield. At the same time, the long-term yields remain elevated because investors do want extra compensation, firstly, for holding on to longer-term bonds. Secondly, because the government is issuing a large amount of debt. So there are still lingering concerns about inflation, about government spending in general. And that is why we're seeing this steepening of this US yield spread, right? So what does this actually mean to us? Because if I just look at this curve, this U curve, right, it doesn't matter as much as, how it's going to impact our investments in the markets, right? So the implication for investors, the way that I see it is this. When we have higher long-term rates, it increases the discount rate, and that can cap the valuation multiples, especially for all the younger growth companies where their value still lies very far into the future. So such kind of companies are those that usually right now they're not profitable, they don't have stable profits, they don't have positive free cash flow, and so on, right? So for this kind of companies, their valuation, their share prices is a lot based on future expectation of where the company might be. But if the rates are higher, then that would tend to cap their valuation multiples. So in contrast, for investors, if we focus on companies whereby they have stronger near-term cash flows, they have stronger pricing power, or they have more durable competitive advantages, this kind of companies tend to hold up better, even in such kind of environment where we have a steepening of the yield curve, of the spread, right? Because these are the companies whereby they tend to do well regardless of the market conditions. They have a lot of resources that is there that allows them to even go through the tough times or the tough economic conditions. So in 2026, the way that we think about positioning our portfolio is whereby we want to shift the focus more towards looking at a more favorable risk to reward profile, looking at companies whereby they are more fundamentally sound rather than simply chasing after which company the share price have gone up the most in the last 1 year or the last half year, right? So this brings me to the point of focusing on fundamentals. And for those of you who have joined me for some other sharings before, you probably will know that I focus a lot on looking at the fundamentals of the companies. We don't just randomly buy companies. Instead, we want to find those whereby they have a more stronger fundamentals. Looking at their earnings, are their earnings improving? Are their margins expanding? Do they have consistent cash flows? What about their balance sheet, right? Do they have a very resilient and healthy balance sheet, as well as do they have any durable competitive advantage over the long term? Because if they're able to tick this checklist, right, what happens is that even in the short term, when the economy is not doing well, these companies will still likely be able to survive. You will still see this company in the market in the next 5 years, in the next 10 years, they are still very relevant businesses whereby consumers are using their products, right? So that's step one, focusing on the fundamentals. Now, once we are clear about the fundamentals, the step two is we want to look at the price that we pay. So this is where the technical analysis comes into the play. So for myself personally, aside from doing FA, fundamental analysis, I also look at technical analysis, TA, to make sure the price that I pay for that investment is at a very favorable risk to reward. So what is the benefit of looking at TA is that it does help us to understand more of the behavior, the sentiments of the buyers and the sellers, right? And in terms of the risk to reward. So this is why after combining FA and TA, this is actually how we invest in the markets and what you might hear about our Moneyball investing framework, which comprises of both the FA and the TA. So FA is to tell us what to buy, whereas the technical analysis TA is on when to buy or the price that we buy. So this guides the decision. And this is what I mean by having a framework rather than just making random decisions based on your guesswork or based on following any tips that you see here or you hear from your peers, right? So what is often being overlooked over here is that both FA and TA, they're actually risk management. Why? Because FA, it lowers our risk whereby we pick only the high quality companies. They have sound financial performance. So by doing that, we're actually lowering our investment risk. And then technical analysis, it allows us to buy at a certain price whereby the odds, the risk to reward is more in our favor. So that is also what we call risk management. Now, for those of you, right, if you're hearing this for the first time, or if you're not familiar with FA and TA, and you are finding it hard to process what I've just shared with you, let me just give you a very quick analogy for you to understand what I mean by, why do we want to look at FA? Why do we want to look at TA as well? Now, just think about a farmer. Okay, I know in Singapore, maybe we are not so familiar with farmers, but just think about a farmer trying to get a good harvest. Ask yourself logically, do you think that a farmer can get a good harvest just by planting seeds blindly? Right? I don't think that is how farmers actually do work, right? Especially the experienced one. So firstly, the experienced farmer needs to know what is the right seeds to plant. Because you need to plant seeds that has demand. Whereby after I plant, I harvest it, I can sell off, I can make money. So same thing in investing, you want to invest in the good companies so that there is still demand over the long term. You can get a good price, a good share price for those companies and make profits. Now, secondly, even after you pick a good seed, you need to plant it at the right weather condition. If you plant it at the wrong weather condition, the wrong temperature, the wrong amount of rainfall, the seed will still not be able to grow well. You will still get a lousy harvest. So similarly in the stock markets, after we pick the good companies, we want to buy at a good price through looking at technical analysis, right, where the risk to reward is more in favor. So that pretty sums up what I meant by looking at FA and TA under our Moneyball investing framework, right? So finally, this approach is especially useful for us, right? As we look ahead, if we are looking in terms of the game plan for the year 2026, I would like to leave you with some guiding ideas. So, firstly, focus on earnings quality. So, keep that at the center of your decision making. Secondly, stay selective. It doesn't mean that when you have a certain market trend that every company in that industry or in that trend they're going to do well. Not every company deserves your capital or your attention. And finally, it's also important to pay attention to the price that you pay so that you buy when there is better risk to reward and not just simply chasing after the hype blindly, right? So when you have a structured approach or a structured game plan, I think that will help you to lower investment risk and give you more clarity in the next 12 months ahead in 2026, right? So before I end off my part, right, I would just like to do a quick shout out. So if you would like to stay connected for more investing insights, you can just follow us at the Joyful Investors. You can scan the QR code on the slide. We are on all the various social media platforms, right? And if you would like to learn more in person, we actually do have in person physical workshops that I conduct that are a few hours long typically. So you can also scan this second QR code on the slide to go and enroll. So these workshops, they are all complimentary. So I hope to see you guys there at the workshop as well. So with that, I will now hand back the time, right? And Billy and myself, we will be going into a fireside chat discussion on the markets.
Yeah. Thanks, Lisa. I think that's a very good guide in terms of how to really get started investing in some of the fundamentals as well as your technical, combining both together. I think that's a very good one. I think we do have some questions, but I think I will take that
Okay.
in a bit later on because I think it's focused specifically on Malaysia. So I just wanted to continue a bit on, I think, on the ones that you've just shared. I think
Mm,
especially you talk about, past winners might not be, might not continue to be the winners in the future, which is very true.
mm,
So how do you see, like for 2026, will it still be very much an AI's growth story, or is
mm.
geopolitics and Fed rate cut become more important? What's your base case on this?
Okay, so if I've been honest, right, I don't think it's like a either or story for 2026. I think all of those that you mentioned, whether is it geopolitics, rate cut, and the last one, I think they're all important narratives that will still continue to play out in this year in 2026. So firstly on rate cuts, if you look at the market expectation, it has really set in the expectation for two rate cuts based on when I last checked yesterday on the CME Fed Watch 2 is pointing to two rate cuts this year. Of course, it's not cast in stone. Things might change. It also depends on how inflation is like, how the world or any other factors that are happening at the same time. But what I do see is that this year, rate cuts are no longer like a surprise catalyst, right? Unlike the year before, because we all are actually expecting them. But if they happen, they will still be supporting certain type of businesses that are more sensitive to the interest rate, such as like our REITs that we have, or companies that might be more highly geared, highly leveraged. So that's for the REITs. Geopolitics, I think, is something you cannot ignore. I mean, we just started the year with uncertainty, right? With the Trump making headlines on Greenland, and then there's now some new updates about it as well. So I think tariffs and all these geopolitical conflicts, they will still continue to be there. It will still result in elevated volatilities in the markets, just like how we saw a sell-off in the markets yesterday, right? But this is something that will still be there ongoing, I believe, in the new year. And finally, for AI, I do believe that AI is a secular trend because there's a lot of data which has shown that there is increasing adoption for AI. So that tells us that AI is no longer just a theme that people are looking at, but rather it's something that's really playing out. There is real applications. How about you, Billy? What's your thought on this?
I think very much similar to you to a certain extent. Just for those who are following us in, especially on our research, I think we do expect a bit more than the consensus. I think our economists actually expect three rate cuts this year.
Mm,
So I think those are positive for the market in some ways, but like you say, it's not really a surprise, right? So it's more or less it's priced in. But I do think it provides a better environment for the businesses because of the lower borrowing costs. So I do think
mm,
it's actually positive for the market as a whole. I think the next thing is probably on the AI growth story. I think one of the easiest way or one of the
Mm,
ways that we really look at is in terms of adoption. I think if you look at earnings, especially from the big tech, then you probably will see some of those in terms of how it actually translates into their bottom line. I think one good
mm,
example is Microsoft because they do B2B. I do think that that's probably the first impact that we'll see, especially in the first wave of adoption of the AI tools. So if you look at a lot of the earnings from Microsoft, for example, you see some of the numbers that they release, especially in terms of the adoption of the Copilot as well as the usage of their cloud for some of this AI. Then you will notice that the adoption is real. So I guess
mm,
the next thing that people and investors wanted to look at, especially for this year, is really whether this will translate into meaningful earnings. I think there are some risks, there are some speculation in it, especially for companies that invest heavily on the data center itself, without much avenue for monetization. I think those are some of the key risks that you want to look at. I think it goes back to what you talked about earlier, which actually
mm,
put it down. I think how it affect your earnings. I think that's very important, right? Your margin, whether it actually helps in terms of that, how it affects your cash flow, and does it give you that sort of advantage in the longer term? I think those are some of the key areas that investors you will be able to figure out as they look into some of those areas. Yeah.
mm. So maybe following on that, something to note on. So because there's always the question that investors are scared that there will be a AI bubble. So what are your thoughts on this? And how can investors really help and protect themselves over the long term?
I think the concern on the AI bubble is because of some of the circular financing that people are seeing, right? Like whether, OpenAI investing into Nvidia, for
Mm,
example, and, all this, yeah, Nvidia investing into Anthropic, for example. So it's basically going around the circle. I think that's the bit of concern on that front. But if you look at, like I say again, you look at how this actually affect in terms of their earnings, especially in terms of both revenue and
mm,
bottom line, I think that's very important. One of the key challenges, of course, in the AI space is, of course, the capacity and sales, the technicality of it. So especially on the large language model portion, I think that there are not too many players. There are not too many big players. Yes, there are some in US, there are some in China and Hong Kong as well. So you have a few, right? But along the way, you probably go back to the same group of players that are involved in the space.
mm,
But if you look at, for example, semiconductor, you can actually see that across the supply chain, you can actually see there are actually more names, there are actually more players. So, for example, South Korea is one of the key beneficiaries of it, right? I mean, if you look at the table earlier just now, the Kospi market has done very well because of that, the exposure that a lot of the AI chip players that are there. So you can see that it's not just a single it's not like just a team, right? Like you talk about, it's
mm,
just something that is structural. It actually brings along that impact. So I do think that if you are worried about the bubble, it's probably company specific rather than industry, I would say.
mm.
Yeah, we're still actually quite bullish on in terms of some of the AI names lah. Yeah.
Yeah, I do agree. I mean, at the end of the day, regardless of what trend it is, because right now it's AI, but in the future there will also be something else, not AI, but in the next decade there will be something new. But it's always about whether the companies are able to generate stronger earnings, stronger cash generation. Just like you mentioned, companies like Microsoft or even companies like Salesforce, these are companies that are still able to generate very substantial cash flow. So in other words, their business are what we call cash cow businesses. So even without AI in the past, they are actually able to do well and they're very relevant businesses. So these are the companies that are still able to survive. I mean, the worst case scenario is what? The worst case scenario is that their AI implementation fails, right? But even without that, they have a very good, strong business model that has demand for its products and services. So I think with addition of AI that can give them the additional boost in terms of their earnings growth or the revenue growth and also in terms of cash flow. So it's about looking out for companies not just because it has an AI story, but rather the fundamentals are still pretty strong, right, in terms of all the resources generation. Yeah.
Hazel, just want to expand on it because you talk about that, and of course your framework on how to
Mm,
basically leverage on both the fundamentals and that. Maybe you could share a practical example, especially on the AI, based on how to take advantage of both the fundamentals and the technical front to sort of
mm.
figure out. I mean, I guess something practical would be great for our
Yeah.
audience.
So maybe using the example of, say, Microsoft that we talked about earlier on, right? So firstly, how do you apply the fundamentals is where you look at the company's financials to understand more about their earnings and cash flow, whether the company in the last couple of quarters, it is still able to generate a very strong, good record of growth and stability in terms of their earnings, in terms of their cash flows, as well as whether the margins, right, in terms of the trend, whether it's still trending in the right direction. Right direction meaning at least stable, but of course the best is growing, right? So this is where you then can pick up the fundamentally sound companies. Then the next thing of TA is you go back to the charts to find out on the technical charts, right? When you apply certain analysis, such as looking at supports, using moving averages and so on, those will help us to identify certain risk, better, more favorable risk to reward. For example, if you look at the Microsoft right now, in fact, it's one of the big tech that is the share price is actually not rallying up to new all-time highs, right? It's in fact down by quite a fair bit since the end of the last year. We are already seeing that. All right, so this is what I mean by finding the opportunities, being more tactical in terms of identifying opportunities. So you find a good company first, and then next you go and look at the price, whether it's attractive right now in terms of risk to reward, for you to do any accumulation in the portfolio. But of course, we're just using Microsoft as an example. It's not like a financial recommendation for you to buy Microsoft. This is just for you to understand what we mean, especially when I talk about the framework that I was using on FA and TA. So that is how we can actually look at it.
Yeah, I think that's very true. I mean, if you've seen it before, I think I think one of the things that we talk about is what's the argument against price, right? So for example, if you look at the technical, I think one of the questions if you can ask is that, so why is it that Microsoft share price is trending downwards, right? Then while the rest are going up, for example. I think there are some news flow in terms of especially on the more negative news flow on OpenAI. Some of those do affect sentiment and things like that. But I think at the end of the day, like you said, if it doesn't affect your if your banks are able to generate that sort of growth, eventually it will be reflected in your share price. So
Yeah.
I think that one
In the short term, yeah, there's always a news, right? Like what you mentioned on that. Yeah.
yeah. Let me just answer because I think Ryan has asked the question for quite a fair bit, especially on the how the Malaysian market, whether it's a good time to enter. The index has hit 1,700, and if it's so, which sector we think is good, and if you have any specific stocks that we wanted to. So quite a fair bit of questions there. Okay, I think first thing is that I think we are quite bullish on the Malaysian stock market. I think there are a few reasons. I think we've talked about that. First of all, is the rate cut. I think we do expect US to cut rate by about 2 to 3 rate cuts this year. Personally, I'm quite optimistic that 2 rate cuts will happen and potentially 3 because I think Trump has signaled that he wanted a Fed that will actually put rate on a lower end of it, right? I think if you look at US mortgage rate, it's still trending at about 5%. I think honestly, it is still slightly on the high side given where the economy is, and so I do think that there will be the rate cut will probably be happening, and we do think that our economists actually expect Malaysia to maintain the OPR rate. So with that happening, I think there will be a bit more flow to the Malaysian side, as investors will probably be more willing to take a bit more risk in terms of the differentiation on the rate between the US and the Malaysian market. Another thing is basically the reforms that we've seen in the Malaysian market. I think Anwar has done quite a fair bit in terms of putting reform. If you look at the trajectory on the deficit level that Malaysia is trying to narrow and reduce, it is really on track. And I think those things are positive for investors. So if you talk to a lot of clients, I think one of the key concerns is really, especially for the Malaysian market, is the continuity of policy, right? I think that's one of the major concerns. But we've seen that quite a fair bit for the Anwar Ibrahim administration. And so that political stability is another key area or key advantage for the Malaysian market. I mean, if you look at ASEAN, across ASEAN, right? You can see, of course, with the exception of Singapore and Vietnam, because Vietnam is not a democracy. So you can see the likes of Indonesia, the new government is probably not as strong as in the past. So we've seen quite a fair bit of protests as well in the street that have caused the death of a Grab rider, for example. Then we've seen a Philippine market as well. So the president and vice president are threatening one another openly, right? And of course, Thailand as well, it has its struggles, it has challenges. So I do think Malaysia is in a quite an attractive position for that. In terms of the sector that we're looking at, of course, I think the first one would probably be your banking sector. We're quite optimistic on that front. So I think bank will probably be one of those that will benefit from that. One of the first layer that will benefit from that. We do quite optimistic on the exporters as well, the semiconductors as well. But of course, that depends very much in terms of the overall sorry global trade, as well as how, I mean, if you've seen, right, if let's say there's a threat on terms of how tariffs will affect some of this, so those will have impact on the semiconductor space as well. But overall, we are quite positive on the market. I think we have a 1,800 15 or 14 level target for the Kelsia index. So yeah. There is another question. I think this one probably, Hazel, you can answer, right? I think, how can an investor tell the difference between a normal market pullback and the beginning of a real downtrend?
Okay. So when it comes to this, right? I mean, if you are looking just on the point of view of technical analysis, right? This is where you start to see wait, how do we define a downtrend? A downtrend is where you have lower highs and then you have lower lows, right? So the start of the downtrend is when you start to see that there are at least three of the lower lows and the lower highs. That is when you can tell that yes, that is downtrend happening in the short term. And then if you switch all over to, say, the weekly chart view, and you still see such lower lows and lower highs, that is when the downtrend is happening for a longer period of time, not just only in the short term when you're looking at it on the daily view, right? But the thing is this, to me, it's not just only whether it's a normal market pullback or whether it's a real downtrend just based on the price movement. I mean, yes, if you are doing trading today, then those are the most important factors, right? Looking at the price movement on the charts. But if I'm talking about investing today, aside from looking at the technical chart, what is important is whether there is something wrong with the company. So is it that there is some change in the business whereby there's a disruption to the business? It is losing its customers, it's losing its market share, its services or products are no longer relevant to the market. Someone else are doing it better than them, and that is why it's resulting in that downtrend, or whether it's a pullback or a bigger crash. Now, if it's because of that, because there's some disruption, the company no longer has a wide moat, then yes, this is something that I will be very concerned about. That if I hold on to any companies like that, I will want to offload them earlier from my portfolio. But the thing is that in the short term, sometimes temporary factors can also cause a market crash, whereby the share price can decline by more than 20% for a stock, even when there's nothing wrong with the company, right? And over the years, there have been lots of examples like this, right? So then in that scenario, if it is due to some temporary factors, whether it's economic factors that will turn, or whether is it some just temporary issues with the industry or with the company itself, then these are times where it doesn't affect my investment thesis in the company. If I hold on to shares of these companies, I'll still continue to hold on to them. So in other words, in summary, how I see this is very importantly, yes, when the share price comes down, sometimes you might panic, especially when it's a deeper crash, especially when the share prices have turned into a downtrend. But the second thing that you need to check before you take any action for an investor is whether there's any real change in terms of the company's fundamentals, whether there's any long-term or structural issues or problems that the company is facing that it's not going to be able to turn around easily. Then those are factors that are important for us to take action on. But otherwise, if not, if I hold on to the shares, I'll continue to hold on to them. Or in fact, if it's at a good price, right, and I have the capital, I have the bullets, I'll be able to continue to add on and to lower my cost over time, right? Or put out a bigger portion on that company. Yeah. So this is the way I see it for investing.
I think we can give an example of what happened recently, as well as I think back in April last year as well. I think when for example recently when Trump talked about the Greenland, and there was the market reacted to it. I think we wrote a report. We talk about it being the base case is that this is a negotiation tactic, and we've seen it before, right? It's not the first time we're seeing it. And of course, if you look at the overall economy as well as some of the fundamentals of these companies, we do think that so this is some of the event triggered sort of pullback that provides that sort of opportunities for investors. I think so. This is just one,
Yeah.
right? I mean, aside from I think the downtrend, what about if markets are at an all-time high, Hazel? Like, what do you think about it?
Yeah.
Is it
Okay.
a good time to go in because
Okay.
you just want to
Yeah.
tap the rally, or is it a bit too late,
Okay. Okay, before I touch on that, right, because you raised the example of the Greenland, it reminds me that of another example to also share for the previous question, which is now that with AI, a lot of the software companies, right, they are actually selling down in the last few months, right? Companies like your Salesforce, Microsoft, ServiceNow. So again, this is another example whereby it's something that doesn't really affect the company, but people are just too focused on the short term news that they're hearing about these companies. But actually, some of these companies, they are also already trying to incorporate AI within their businesses, and they are actually seeing results, they're seeing growth, but their share price can still be down. So that is another example where it's temporary. You might see some downtrend for some of these stocks, but the thing is, does it change the fundamentals or not? Then moving on to the question on when we have an all-time high market, right? Yeah. So right now, I'm not sure how the market is like for US. Haven't had a time to go and look at it for today for pre-market. But in the US market, there are a lot of times where you see the markets continue to go up, the S&P 500 continue to go up, and people are wondering, in an all-time high market, how do I invest? Is it risky to go and buy more? So the thing is, yeah, if you look at the overall market, right, like S&P 500, Dow Jones, for a good amount of time, we can see that most of the time they're actually trending up. It's because of some of the heavier weightage components like the big tech, which are rallying and that's pulling up the prices. But if you look at the market breadth, there are times where the market breadth is actually on the lower side, which means to say there are many other companies which might not be doing well in terms of the share price performance. But why the whole market is still going up is because of some of those big tech that's pulling them up. So there are actually a lot of examples like this, whereby there are good companies that are kind of what we call on sale, but people are only looking at the other companies like the big tech. So they miss out on certain good opportunities to accumulate some of those companies that are on sale. So even in a usual market where the markets continue to go up to all-time high, where the S&P 500 go up to all-time high, usually there will still be some pockets of opportunities in certain sectors, certain industries. So we just need to look further beyond just looking at the overall market. If you look at sectorial ETFs to give you an understanding of the price performance, it might give you some hint, or looking at some of the individual companies that you do know of that are in your radar and they are good companies. You might find that there are opportunities from time to time, and these opportunities they come and go, right? So whenever they come, it's important that if you know how to grab the opportunity, you will be able to build up a portfolio of very solid and resilient businesses. How about for you,
Okay, sure.
Billy?
Sorry.
How about for you? How do you see such a scenario when when the market continues to go up high? How would you usually invest?
I think usually the first question that I would have is that I would ask the question of, why am I against the share price rally or, uptrend or whatever, whether it's uptrend or downtrend.
Mm,
Because to take a sort of contrarian to what the market is means that you assume that there's something wrong with the market expectations, right? And I do think that every year at the start of the year, I heard this same question. Maybe I've been in industry for long enough. Every year they talk about whether it's this is the bear market, whether there will be a crash and there's this risk. And every year there are different
yeah.
sort of key risks to really look into. And of
Mm,
course, those risks are very real. But I'm just saying, I think at the end of the day, investing, you probably need to, like you say, I think it's important to look beyond just the overall market as a whole. I think that gives you a glance in terms of where the sentiment is, but you probably need to
mm,
look at what companies are growing or what companies are doing well, for example. So I'll just give you an example, right? I think probably you might not like the company, but so for example, we did talk about Intel quite a fair bit. I think part of the reason is that we think the structural opportunities for Intel is there. I think, of course, we've seen some rally in the share price quite recently, but we've been talking about that even prior to the rally that we've seen, right? We've talking before the US administration actually step into and get a lot more involvement with Intel. But one of the things that we talk about is the sort of geopolitics that we are seeing today, that we have been seeing for quite a fair bit, the tension between US and China, right? And Intel getting into the fab business allow them to provide an alternative to TSMC per se, right? And TSMC, while they have a lot of advantage in terms of the tech, is located in Taiwan. So one of the key risks that we are looking into is how this will affect US companies that wanted to diversify away from the risks of China, right? So we've been talking about Intel for quite a fair bit in terms of the investment, and we're looking into that. And we've seen some of that movement today. But I think at the end of the day, it's looking at company specific and looking at what sort of drive that growth there, rather than just, looking at the market as a whole and say, it's doing well.
Right. How about, okay, let's shift gear to the SGX market now. Okay. So, the SGX market has been gaining, traction quite a fair bit over the last 1 year, right? So how do you see investors positioning themselves into the Singapore market, whether it's investors from Singapore, investors from Malaysia? Do you see it more of a case of investing into the SDI leaders, or riding on to the mid and small cap rally that is expected from the EQDP boost?
So I think the answer really depends on where the investors are starting from. I
Mm,
think I talked to a lot of investors in Singapore, and to be honest, it's quite a surprise to me that a lot of Singapore, especially the younger ones, do not
mm,
start their investment journey with the Singapore market. They actually start with US market and all that. When I talk to a lot of my Malaysian, usually they do start with the local market. And I think that
uh,
but we've been promoting, or we've been talking about the Singapore market for the longest time, for the last 4 years, I think even prior to the
mm,
EQT. So when I was still in Malaysia, I was actually talking to Malaysian investors that how you should actually, especially for Malaysian investors, you should really diversify and some of it into the Singapore market. Reason being because your earnings are in Malaysian ringgit, right? You're buying property that are in ringgit. So everything is basically dominated in ringgit. And of course, your EPF, even then, the investment, big chunk of it is also in the Malaysian market. Well, there are there are pros to it, there are also downside to it, right? So the really best way to hedge it is really to look at the Singapore market, and the Singapore market provide that sort of stability that is not seen in a lot of the market. Because I think some of it quite boring because of that. Because of that, right? I think we've seen a lot of investors avoid at the Singapore market because of that. But that provides you with that sort of income dividend play, right? So
mm,
you have your banks and all that. So we've been talking a lot about that. And it's also very important to take note that a lot of the Singapore, especially the one on the STI, they're not just Singapore or local players. They are actually
mm,
regional champions, right? So for example, ComfortDelGro is not just big in Singapore. Yes, they're very big in Singapore, but they have actually expanded beyond just Singapore. DBS is another clear example, right? So a lot of the Singapore players are actually not just local champions. They are actually regional champions that are expanding to tap on growth beyond Singapore. Of course, the EQDP that the 5 billion that MAS
mm,
announced, it really helped to boost interest and drive more investors into the Singapore market. And we actually seen a lot more. I think a lot of that flow actually go into the STI rather than just the small and mid cap. But the small and mid cap has had a great run for quite a fair,
mm.
right? And I think again, it depends on you. If you have not been investing, I think you will really should start with the STI leaders. But if you have already been investing in Singapore market, I think it's also time to really look at some of the opportunities in the small and mid cap space. Yeah.
Yeah, that makes sense. I think, yeah, at the end of the day, whether it's the leaders or whether it's the small and mid cap, what's important, it goes back to the framework again, right? Is to make sure that the company it's doing well, it's sound, the fundamentals are strong, so that it's not just a short-term boost through whatever policy shifts, because there will always be changes in policies, changes in the economic conditions, right? Macro environment, or what is happening in the world globally. But if we look at the better companies, those with a more sound balance sheet and also their profit and loss, then yeah, these are the companies that tend to do well over the long term, right? And they'll be able to grow and compound faster. So I think that is the idea. It's not just simply restricting yourself, but rather to look out for good ideas, good companies, good businesses. Yeah, even in the SGX market, or even in the US markets or China, Hong Kong as well. Yeah.
Hazel, I think there's a question on whether it's, especially for investors who are just starting, is it better to start off with stock
Oh,
or is it
okay.
better to invest by ETFs?
Okay, okay. Yeah, I think this is a very important question because this is something that you always have to come about, right? You have to think about, ponder about when you are starting off investing. Do I do individual stocks or do I do ETFs? And to me, there are two important factors that you want to look at. Okay, but of course, these two are not the only factors. The first is do you have the knowledge or the skill set lah, to look at individual stock? Because to be able to pick individual companies, you need to know how to look at their company's financial performances, which is something that not every investor might be able to perform at the point where they are starting out investing. So if you're actually able to do it because you have picked up the skills, you have learned how to assess a company's fundamentals, then, well, individual stock selection might be applicable or suitable for you to look at. But on the other hand, if you're someone who is completely new, you really don't know how to look at businesses and analyze, right? Then ETFs would be a good, a very beginner friendly starting point for you because the fact that you just buy one ETF, you're instantly diversified, right? So you don't need to go and pick or think about, oh, how should I construct my portfolio? But rather, they have already done it for you, right? And you can just tap on that. So that's the first factor. The second factor is to think about, do you have the time and interest, right? I have to be honest, some people just don't have interest. Even if they have the time, they might not have the interest. They want to spend the time to do other things. They just hate looking at numbers, looking at companies, right? So if you belong to that group who don't have interest, then it's fine. Then ETFs are a very good and suitable choice for you. But on the other hand, there will be investors who are new, but they really want to have autonomy in the selection of the stocks. They want to pick the best of the best. Then this is where individual stock selection might be suitable for you. So you need to think more from your own perspective, right? Based on your own circumstances, looking at whether you have the knowledge and also whether you even have the interest or not. Lah. Yeah, I think these are important factors to think about before thinking whether should I do stocks or should I do ETFs.
Okay. I'm just gonna add a bit on that. I think another way to look at it is aside from that is if you are
Mm,
in a market that you're not familiar with. So for example, for Malaysian
mm,
starting to invest in Singapore market, right? If you're not very sure how to invest, maybe the easiest way to get started is to go into ETFs. That's
yeah.
one of the example, right? So you can skip the hassle of trying to find out which is the leaders within the market. Another example is if you want to tap on structural growth like in countries or in markets like India or in Vietnam, for example, but you don't have a knowledge or you don't have a presence there, it's a bit difficult
Mm.
for you to understand what's going on in that country because you don't have information, right? You don't have a on the ground check. You can't see which companies are doing well. You can't talk to the management. A lot of that are just from the internet, and information flow in some of these countries are probably less as compared to like in the US market. So it's probably a bit difficult to invest in individual stocks. So then it makes, ETF becomes a very good tool for you to really gain exposure into it. So
Yeah.
yeah.
Maybe something to add on is also, there's sometimes when you have a pretty new industry that comes up or a pretty new theme that comes up, and you are not clear of who is the market leaders, right? Because they're still at the very initial phase of growth. Then this is where again ETF might be useful because you don't want to bet on which is the company that's going to do the best, right? That's going to emerge as the leader. Then for such kind of industry or themes, then I think the thematic ETFs, these would be a good choice for investors as well. Not just for beginners, even for experienced investors, whereby you think that you don't want to subject your stock selection to too high a level of speculation. So instead of betting on individual companies, you bet on the whole industry or the whole trend. Yeah, then that is also another valid reason why ETFs might be useful in that aspect. Lah. Yeah.
Okay. I think we're reaching the end of the session soon. So probably just gonna end with this. I think overall you're quite positive on the market. And of course, like you say, you look at probably more on company specific, right? But what are some
Mm.
of the key risks that keeps you sort of awake at night, right? And things that, that you are probably more worried about.
So for me, when I look at news, I do read news, but for me, when I read news, right, events like Trump tariffs and all that, or geopolitical conflicts, this to me, they are more for my understanding of what's really happening in the world, but not necessarily they might be areas where I think is of a risk factor to my investment portfolio. Because I think at the end of the day, if you really have your own watch list of companies that you are really very confident in, that you have conviction in, then during times when there is heightened volatilities in the markets, right? Then those are very good opportunities for us to look at. So in terms of risk, to me, what counts as a risk is when I buy something whereby I don't actually believe in, right? If we chase after a trend just because the prices keep going up, just because the everyone around you seems to be talking about it on the headlines, you see them, you see the news covering about that, you see social media covering about that. Everyone is telling you about this company or this asset class or this investment. Yeah, to me, those are where the level of risk might be higher if I simply just jump right into it without understanding, and if I just blindly chase after the prices. Because as you know, my in my framework I do TA, right? So on TA I will always like to buy at a good price where there's better risk to reward, instead of just blindly chasing after the rally or chasing after the trend. So when there are events like this, and they are always present, there's always something, a new theme or a new investment that seems like a hot idea or popular idea. So to me, I would want to avoid just simply chasing after these trends blindly, lah. And that is something that is an important and key investment risk that actually a lot of investors fall prey to.
Okay. All right. I think let me see if there's anything else. Yeah, I think yeah, you can send over to
Recording.
on the
Uh, I think it will be recorded, right? The
yeah. And the slide I can send over. Are you okay to send over the slide? I think it's okay.
for me, maybe not to share the slides over lah, but with the recording, they can actually have the slides already lah.
Okay.
Yeah.
Because for my presentation, I can actually share over the slide. Those of you who wanted to know some of the overall macro thematics and strategy that
Mm,
you have is actually in the slide and on the overview. So we can actually send that over when you ask. I think that's all for us. I think that's it.
Thank you all for joining us tonight.
Thank you so much for your time. I know you're having it during your dinner time. Sorry.
Thank you, Billy, for the sharing too.
Yeah. Thank you, everyone. Thank you. Bye.
Thank you. Bye bye.